In this video, let's talk about finding an investor-friendly lender. So as a real estate investor, you're going to need capital to purchase properties. At some point, you're going to not have all of your own capital anymore. You're going to use it up on renovations, or you've bought into other properties all cash. So you're going to need to make sure you're using all the different capital options at hand, not just your own cash. So having a lender, they can provide capital for you to make the purchase process easier so you can save your money to do other things with, such as the repairs, such as paying bills to maintain the property from month to month, like your taxes, insurance, utilities, so that you don't get into a situation where you get foreclosed on and lose the home for not paying these other expenses. So make sure you have plenty of cash on hand. Utilize the lender to help provide the bulk of the cash to buy the property with. So in this case, finding an investor-friendly lender is important for making sure that they lend on investment properties, because most lenders like to lend out to traditional homeowners, and they require special requirements to investors that they don't require homeowners. For example, the down payment amount changes when you're buying investment property as opposed to buying a personal residence. Usually lenders require minimums of 15% down. Some go up as high as 20 or 25% down as a minimum down payment. You have to come out of pocket, and then they pick up the rest of the purchase price with a loan that's 80-90% of the value of the property. Now in this case, with a traditional home that you're buying as a personal residence, you can get away with putting as little down as 3%. So one strategy you might have is to just buy the home as a personal residence, getting that low down payment option with the lender, and then down the road decide maybe after a year or two you want to lease that property out and turn it into an investment property. That's one way to go about it. Now with lenders on the investment side, they're typically also going to have higher interest rates, so you want to check around and make sure you're finding ones that have reasonable rates for investors. So if the traditional home buyer is getting in at 7% interest rates to buy their personal home, but investors are getting charged maybe 9% interest rates to buy investment properties with. So keep that in mind, that the interest rates can vary by quite a bit. So you want to make sure you check into all the different lenders in your area to see which ones are the most friendly towards investors, and they don't charge a really high premium to investors when it comes to those mortgage rates. You also want to consider the amortization period. A lot of times when you get into bigger properties like multifamily or office space, they have balloon options where you only get to pay a fixed rate for a certain period of time, and then the loan balance comes due. So the amortization schedule is much shorter compared to your traditional mortgage, like on a personal residence where you're getting a 30-year fixed mortgage. A lot of times lenders on investment properties call the loan due after 3 years or 5 years. So you have to refinance every 3 years or every 5 years and get a new loan product to keep that property financed. So with that being said, check into their different options to see what amortization schedules they have, what loan options they have, so that you can make sure you're picking the best loan product so you don't get caught in a squeeze in year 3 or year 5 where the lender all of a sudden has the loan due and you might not be in a financial position to refinance, and this may force you to liquidate and sell the property since you're gonna have that loan come due and you don't want to lose that property to foreclosure to the bank. So investors, again, kind of get the worse treatment than homeowners do, but if you find a friendly, investor-friendly lender, you can make sure you're checking off a lot of these boxes to where the differences are pretty subtle. You don't have to worry about major differences where you're at a disadvantage taking out an investment loan compared to doing it as a personal loan. So again, if you get into a situation where you have the ability to purchase these properties as a personal property and later turn them into investment properties, that could be a creative financing strategy to help you get better lending terms. But there are some legal things you need to know about doing it that way. A lot of lenders make you sign a contract stating you will actually be the occupant of the property for at least a year, so that you don't just buy it as a homeowner but then turn around and rent it out a month later. So that would be loan fraud. So they make sure to protect against loan fraud by having you sign some different disclosures. So make sure you keep an eye on those legal documents and make sure you're doing things ethically so that you don't get in trouble legally when you're doing a loan product a certain way, only to then turn around and try to use it as an investment property. All right, so to find investor-friendly lenders, the first thing you want to do is talk to your network. Do you know other investors out there that have been buying properties for several years that you can speak to see who they use and would recommend you as a lender? This can help jumpstart some of those meetings where you meet with different lenders to see if they're going to be a good quality lender to do business with. If you want to find out different terms and pricing, fees, interest rates, go ahead and send out kind of a blanket email to at least 10 different lenders and see which ones respond back with their different fee quotes so you can compare apples to apples to make sure you're picking ones that have favorable terms as an investor. And then lastly, it's going to come from experience. So after you do business with lenders over time, you're going to learn kind of the ins and outs of the lending industry in your local market, and you're going to get a better feel of which lenders are easier to work with than others, and this can help you move forward picking the best lender to work with.